We mentioned in the beginning that we are right now in the middle of hours of a rapid decline, a flash crash in silver and perhaps other commodities as well that you can help us identify. We noticed during the middle to early weeks of the Iran conflict that Turkey, for example, had to liquidate a lot of their gold, perhaps a majority of their sovereign gold holdings, which was a great weight on the gold market for some time, rather than seeing that as a decision to switch asset classes. Some people have called it just a liquidity crisis, that tapping resources that can always provide liquidity and functioning as the savings account that anyone, whether a sovereign nation or individuals, might need. Can you talk to us about what you believe to be the fundamental driving factors behind the recent waterfall declines in precious metals?
Well, some countries are selling. That's definitely a factor. But we don't know how much of a factor it is in the moment because they don't report what they do until later on. But yeah, there was a lot of selling going on at the beginning of the Iran war. And there's no reason to think that there wouldn't be some selling now as countries grapple with sudden energy shortages. So that's probably part of it. And another part of it is that stocks in general are tanking, and that normally pulls precious metals down. If you look at 2008 or 2022, in both cases we had dramatic and quick bear markets in equities, and gold and silver tanked right along with them. So historically, this is kind of a normal thing. It doesn't really say anything about gold and silver at the moment, except possibly with interest rates going up. It could be that suddenly we're expecting monetary tightening, and that's not normally a great thing for gold and silver. I don't think the monetary tightening story has legs, though, because as soon as there's any kind of a crisis out there, the Fed will shift over to massive easing. And I think what's happening in the stock market now, if it continues, if we have some more bad days, then we'll stop hearing about the Fed tightening and start hearing about how aggressive they're going to be with their upcoming rate cuts. And what has happened in the past is that everything tanks and gold and silver gets pulled down along with equities, and then the central bank aggressively starts easing, and then that liquidity flows back into precious metals, and they do okay again. So I think that's probably a big part of the precious metal story right now. And the nice thing about that is that it has a happy ending historically. And it's just a question of when the Fed shifts gears and starts talking about tightening. And I think it could be any day now. Just a couple more days like this, and they're going to be in full panic mode.
It's interesting, the difference between being in panic mode versus licking your chops when there's blood in the streets. Rick Rule has talked to us for years and years, over a decade, of positioning yourself to be a contrarian by being prepared to take advantage of situations rather than being taken advantage of. And as a gold and silver dealer, I speak with clients all the time. I have lists of clients who say, call me when there's a sharp down day, and others who say, I've got to sell because it's dropping, or that kind of thing. I've got to buy because it's hitting all-time highs. It's remarkable how different, sometimes it's opposite reactions from different constituents. Talk to us about something that you've written about on a recurring basis over the years, about positioning yourself with lowball bids and keeping some powder dry and being able to take advantage of sharp pullbacks at a time when the underlying fundamentals still support robust improvement and appreciation in the future when you see these opportunities for entry that may be not too late.
Yeah, I've been repeating that message ad nauseum on Substack, which is don't jump with both feet into anything just because it looks good in the moment. And with gold and silver, we should keep our eyes on the eventual prize, which is a monetary reset somewhere in the intermediate term future, where gold moves back into the center of the monetary system at maybe $15,000 to $20,000 an ounce, and silver is pulled up by that to a couple of $100 an ounce. Keep that in mind, and then gradually add to really good high quality names. In other words, buy physical gold and silver to start with, make that the bedrock of your financial life, and then start looking at commodity stocks, because commodities are extremely cheap compared to financial assets right now. So buy the highest quality gold mining and silver mining stocks, a little at a time. And then once you feel like you have enough of those, dollar cost average or use lowball bids or whatever to get into the mid tiers and so on, and educate yourself along the way. Learn from your successes and failures with your initial small positions in these things, and then use that knowledge to make better decisions about what you want to be adding. And so this is a long-term process. We shouldn't be looking at any single trading day and changing our strategy based on it. And right now, if you have some low ball bids out there, actually, I did a Substack post a while back about using a low ball bid, how you do it and everything. And it was with Hecla Mining, which is a big silver miner. And it just got hit a couple of days ago. So now in our portfolio is Hecla Mining at $15 a share. And we all know how to use lowball bids to buy cheap stock right now. But now Hecla has to stop falling, though, because it's already down to $14 this year. So one of the risks if you use lowball bids is that the stock you're trying to buy just blows right through your bid price. And you have to put up with a kind of a V bottom before it goes back up. But and dollar cost averaging is kind of a similar concept where you buy the same dollar amount of the high quality assets that you want to get into, say each month. And when the price of those assets is up, you get fewer shares or fewer ounces. When the price of those assets goes down, you get more shares and more ounces. And so over time, you build up your positions at a really favorable average price. So this is another situation where that is a good strategy because things are tanking now. So if you're putting X amount of dollars at the end of this month into some good gold and silver miners, for instance, all of a sudden you're going to buy more shares than you bought last month and the month before. So your average price is going to improve. And, times like this really validate that kind of gradual, steady accumulation and a complete lack of interest in what's happening in the moment.
When you've described this process of laying in wait and actually hoping for a pullback as an opportunity, it reminds me of how often I get calls from subscribers or clients saying, gee, I hate to pay up when we're hitting all-time highs, but I guess we're always going higher. And I know Michael Oliver, among others, has been calling for a radically higher price regime for precious metals. What barriers do you foresee that precious metals would have to get through before we would be likely to see significantly higher nominal prices?
Okay. Well, first of all, let's examine the difference between a secular high when everything has made its peak price and it's headed back down, and a correction within a bull market. And that has almost nothing to do with the assets in question. Like gold and silver aren't doing anything right now. And whether they're good investments going forward depends on whether we're still in the same situation with the same big trends that led them to go up in the first place. And the big trend that we have to be watching, because it tells us whether we're at the end of the cycle or just in the middle of the cycle, is government finances. If governments are still running massive deficits and still having to finance those deficits with a torrent of newly created currency, then we're right where we've always been. We're debasing our currencies. We're basically destroying the world's big fiat currencies, and that's going to lead to a currency reset with gold and silver much higher. So until that changes, then we're still in a bull market for precious metals. And that is emphatically not changing. All the big governments of the world are running insane deficits. And they're having to create a lot of new currency to cover the interest costs. So we shouldn't be worried about this being like 1980, which is the secular end of the gold bull market, and 20 years of down prices are coming. The fundamentals don't point towards that. They point towards higher inflation as governments get more and more desperate to finance their way out of the debts they've taken on, and that's good for gold and silver. So what's happening right now is not something that is the end of a cycle. It's more of a midterm course correction, consolidation kind of thing. So we shouldn't be worried about where we're going to be in 5 or 10 years. And in the meantime, we, trading, making decisions when markets are being very tumultuous is just hard because your emotions get wrapped up in it. And that's why just adding gradually to the positions that you like takes a lot of the emotions out, because you know what you're going to do. You know what you're going to do at the end of the month. You know what lowball bids you have in place and where you'll get taken out. And you don't have to decide in the face of the markets going crazy. So I think any kind of a rule you can set up for yourself that takes some of the emotion and some of the angst out of it is healthy. And I think a focus on long-term trends rather than short-term squiggles in the market is also healthy. So as long as we're in the process of destroying the world's fiat currencies, we definitely want to be continuing to accumulate gold and silver.